Introduction to Time Value of Money, TVM. The time value of money, TVM, is one of the most important principles in finance. It states that a unit of money received today is worth more than the same unit of money received in the future. This foundational concept stems from the potential of money to earn returns over time, inflation effects, and risk factors. TVM is essential to capital budgeting because investment projects generate cash flows at different time periods, and we must compare them on a common time basis, typically in present value terms, to determine whether a project adds value. Core concepts of TVM present value, PV. The current worth of a future sum of money or stream of cash flows given a specific discount rate. Formula, PV, FV, 1 plus NPV, C, TAFRAC, FV, 1 plus R, none, where PV as present value, FV as future value, R as discount rate, interest rate, N as number of periods future value, FV, the value of a present amount of money at a future date, compounded at a given rate. Formula, FV, PVX, 1 plus R, NFV, PV odd times, 1 plus R annuity, a series of equal payments at regular intervals, e.g. yearly, quarterly. Present value of an annuity, PV annuity, CX, 1 plus R, NR, PV annuity, C R times has left, R frac among 1 plus R, N or N right, where C cash flow per period, R discount rate, N or number of periods. Perpetuity, an annuity that continues forever. PV of a perpetuity, PV, CR, PV, Y, FRAX, C or compounding and discounting. Compounding moves cash flows forward in time. Discounting brings future cash flows back to the present. TVM ensures that capital budgeting techniques like NPV, IRR, and PI can compare monetary values across different periods using discounting. Relevance of TVM in capital budgeting. TVM allows financial managers to evaluate long-term investment viability, compare investment alternatives with different timelines, account for inflation, risk, and opportunity costs, calculate appropriate project returns. Any failure to apply TVM concepts can lead to misleading investment evaluations, resource misallocation, and long-term value erosion. Adjustments for working capital. Projects often require an initial investment in working capital, inventory, receivables, etc. This is a cash outflow at the start, but usually recovered at the end of the project. For example, year 0, increase in working capital, cash outflow. Final year, recovery of working capital, cash inflow. If not properly accounted for, working capital can understate or overstate cash flow estimates, leading to misleading investment decisions. Tax considerations in cash flow estimation. C. Taxes significantly impact net cash flows. Analysts must consider depreciation's tax shield. Non-cash expense reduces taxable income. Capital gains or losses from asset disposal investment tax credits. Changes in tax regulations over time. Tax loss carryforwards. Tip: always compute taxes on pre-tax earnings, then deduct taxes to arrive at post-tax cash flows. Depreciation and the depreciation tax shield. Depreciation is a non-cash expense but provides tax benefits by reducing taxable income. Depreciation tax shield, such as depreciation x tax rate, common depreciation methods, straight line declining balance. MAKE-RS, Modified Accelerated Cost Recovery System in the US. Choice of depreciation method affects the timing of cash flows and the project's NPV. Inflation and cash flow estimation. Cash flows must be expressed in nominal terms, including inflation, if the discount rate is nominal. Alternatively, use real cash flows with a real discount rate. Mismatch between cash flow type and discount rate leads to incorrect NPV calculations. Inflation impacts: future cost of inputs, labor contracts, maintenance expenses, sales prices, cannibalization and externalities. If a new project reduces the cash flows of existing operations, these reductions, called cannibalization, must be subtracted from the forecasted benefits of the new project. Conversely, positive externalities, e.g., brand recognition increase, customer loyalty, may also arise but are often harder to quantify. Common mistakes in cash flow estimation, including sunk costs. Ignoring opportunity costs. Inconsistent use of nominal versus real values. Excluding working capital requirements. Overestimating terminal value. Not accounting for project delays or cost overruns. Using accounting profits instead of cash flows. Summary of cash flow components. 주어, category, description, and cash flow timing. 1. Initial outlay asset purchase, installation, WC, year 0, 2. Operating cash flows, revenues, expenses, taxes, plus. Depreciation years, 1, N, 3. Terminal cash flows, salvage, plus WC recovery, exit costs, final year.